All right. Well, it's 10 o'clock. Do you guys want me to kick it off?
Sure. Are we expecting more people or a lot more people or most good chunk are here?
You know what? I'm not 100% sure how many have been attending in person, Jonathan, to be honest. But I know that we'll be sending out the recording even for people who are not here in person. So
Right. I think we usually get 15 maybe.
Okay. Well,
up to 20.
looks like we're up to like 6, so people are starting to log in a little bit now. Do you want me to give it 2 more minutes?
Our intros are going to take more than 2 minutes.
Okay. So welcome everyone who is joining us. For those who are wondering about Tanya's strange voice today, it's actually Leanne. I'm Tanya's operation leader, and Tanya has been delayed in her travels and unable to join us. So I am going to do my best to kind of get the guys here going, and then I'm going to let them take it away. But please bear with me as it is my first time hosting this particular webinar. So if at any point you can't see what you're supposed to be seeing, please throw a comment up for me, guys, and give me a little bit of feedback, because as I say, this is my first time running this particular series. So just to welcome you all to Enhancing the Accountant Bookkeeper Connection series featuring Kata Accounting. It is normally hosted by Tanya, but today you've got myself, Leanne. As I mentioned, I am operations leader at Cloud Bookkeeping Services, and I also help Tanya with running our Tanya's Bookkeepers Bootcamp. A little bit about Tanya and us is that we do have our Bookkeepers Bootcamp, which now qualifies for CEC credits. We were the Intuit Global Firm of the Future for 2018 and runner-up in 2017. Tanya is one of Practice Ignition's top 50 women in accounting for 2018, 2018 Inspire Bookkeeper Award winner, and top 21 influencer in the Canadian Bookkeeper World 2018. Insightful Accountant top 100 ProAdvisors for 2018 and 2019. HubDoc top 50 accounting firms in 2018 and 17, a Black Swan alumni mentoring under Ron Baker. Her and I are both Futurepreneur Canada volunteer mentors. We really believe in giving back. Tanya is a member of the Intuit Trainer Writer Network, Advanced Certified QBO ProAdvisor, and Certified QB Desktop ProAdvisor, as well as many other apps. She is a certified professional bookkeeper with the IPBC and has over 20 years bookkeeping and income tax experience. And some of her photos, just so that you can kind of see her passions, are her family experiences, and she is working on learning American Sign Language. So this particular webinar, we are in the process of submitting for the CE credits. We don't expect there to be any problem with it qualifying for CE credits, but again, with Tanya's travels, it's just a little bit delayed. So once we get that approval through, everything will be sent out, and we don't expect to see any issues with that, but it's a little bit delayed. There will be 2 polls that you must answer in order to qualify for the credits. So I will do my best to operate those and we'll get those polls up. So you do need to answer both in order to qualify. And we will have a recording of the webinar sent out via email so that you can review at your leisure. And then as well, certificates, once we get that CE approval, will be emailed out as well. So Kata Accounting, I'm really excited to introduce you to Jonathan and Bob. We've been collaborating with Jonathan and Bob for a number of years. We've got multiple mutual clients. It's great to work with accountants who work so easily in QuickBooks Online, and their attention to detail has certainly led us to be better at what we do as well. So we really appreciate them and everything that they do. So that is all I have for me, and it's time for you guys to take it away. So Jonathan, I believe you're going to share your screen now.
I am. So can everybody see my screen now?
Sandra's saying no. Oh, Sandra's saying yes. Okay, we're good to go.
So today's topic is continuing our management accounting series. Today we're going to be talking about long-range financial planning. Just a quick thing about us. So my name is Jonathan Carter, CPA, CMA. I'm considered a thought leader in accounting and technology. I was a member of the inaugural Intuit Accountants Council. That was a steering committee, kind of a steering committee that helped Intuit develop the QuickBooks Online product and profile tax products. I'm an elite we are elite ProAdvisors with an Intuit All-Stars and winner of the 2018 Inspire Accountant Award. We're known collaborators. We're big on collaboration and on communication, and we have a strong desire to see improvement across the industry. When we first got going, there were a lot of times where we get files, and there were some shocking things. So we'd like to see overall the files that businesses are provided with are better and better. Personally, I have extensive experience in the mortgage industry with rental properties. And as a firm, we do a lot of bookkeeping with e-commerce, digital, and affiliate marketing. We do tax on a broader scale, but we try to really niche our bookkeeping and pass along to people who are more specialized when we get those odd requests like that really don't fit our model, like realtors or mortgage brokers, for instance. We like to send those to people who focus on realtors or on mortgage brokers. I'm also a member of the Japanese Canadian Cultural Center's board. I was brought in for my QuickBooks expertise to help them switch from Simply to QuickBooks Desktop Premier, and I'm currently in the process of trying to talk them into going to the cloud. And I'm an avid fisherman and MTG and poker player, although I don't really do any of those as much as I would like to. Bob, you want to tell us a bit about you?
Absolutely. Good morning, everyone. It's wonderful to have you with us. I just lost the screen. Okay, I've got it back. I need to read this because I can't remember everything I've done in my career. So I attended the University of Waterloo. Then I worked with one of the big four CPA firms after I left the University of Waterloo. I worked for, they were known as the Big Eight back in my day, by the way. So that tells you how long I've been kicking around the accounting and finance world. I made my way up to the manager level. Then I went into financial planning roles in a couple of different large public companies. I'll actually say a little more about that because it's really pertinent to the topic for today's webinar. Back in that day, the way a lot of CAs left CA firms was to go into an internal audit department with a client or a large company. I was fortunate to be offered a position with Shell Canada in their financial planning department. And this was at the corporate level, working downtown on King Street. I stayed there for, I don't know, 4 or 5 years, learning a lot about financial planning, how to pull a financial plan together, how it's used, and how it adds value to the overall finance role. Ironically, I then it was strongly suggested that I move into the internal audit department. So I did not manage to avoid internal audit, despite thinking I was such a smart fellow to get out of a CA firm and not have to do internal auditing. I was then hired to develop a financial planning model within another very large public company which had just recently been pulled together through a couple of mergers. And at that time, they were one of the leading companies on the TSE. They did not actually, because they were so new, they did not have a financial planning model. They weren't able to present long-range financial plans to their board of directors. So I was hired as the manager of financial planning to build that model and make it work, to maintain it, and I was very pleased that we were able to present 5-year financial projections to the board of directors within 6 months, I believe it was. So moving on from that, I moved to different roles in different companies through various takeovers and machinations. And I've developed a number of pretty complex planning models that involve consolidation of disparate entities, multi-currency, mergers and acquisition, and some complex tax implications. I have experience as a result of moving around that much in various industries, which you can see there. And then I took on and became an independent consultant, hung out my own shingle and worked for a number of different companies. And on a personal basis, I currently live in Georgetown with my wife and our 4 cats. And I enjoy a few things, woodworking, travel, car maintenance, which I've recently taken up. And so far I haven't broken too much on my car, and doing stock market research. So that gives a little of my background.
So today we're continuing our management accounting series. Some simple definition, the provision of financial and non-financial decision-making information to managers. This could be things like, for retail, how does the weather affect your sales? It could be something like, you know, what we're doing today, long-term financial planning. Could be short-term financial planning, could be budgeting, all kinds of different things. It's very informative. It goes well beyond just looking at financial statements. And it's a profession that involves partnering in management decision-making, devising planning and performance management systems, and providing expertise in financial reporting and control to assist management in the formulation and implementation of an organization's strategy. One of the things that we were taught as CMAs was that everything needs to tie back to strategy. If you have people in, like at the grassroots level who are not operating in direction with your strategy, you need to find a way to get them to operate in such a manner. So who uses the information? For management accounting, it's generally insiders. It generally does not leave the company. The only time you might have that go out is if you're looking for funding. Financial reporting typically is used by outsiders. That would be lenders, banks, potential investors. They'll definitely want to see the financial reporting as well. So is it required? The financial reporting quite often is required, either by lenders, maybe on a bank covenant if you have a bank loan. It could be required by law, especially for not-for-profits. You have to have audited financial statements over a certain level. Management reporting is all at the discretion of management. And I think that might be part of the reason that it's harder to convince clients to actively participate in management accounting. So the scope of it, the financial reporting, of course, reports the big picture, everything. But the management reporting can focus, really narrow in on a product line, even right down to an individual salesperson creating something called a balanced scorecard or key performance indicators, KPIs, things like that. The focus on financial reporting is always looking backwards, whereas management reporting looks backwards in order to look forwards. So that's some of the key differences for management and financial accounting. So our first survey, how many of your clients do any kind of formal budgeting, planning, documented or regular reports? 0, 1 to 5, 5 to 10, or over 10.
Okay, I'm going to launch that for you here. So if everybody wants to take a second to answer, please remember that in order for us to issue those CE certificates, I do need you to answer both polls today. We're getting there. We've got almost everyone, maybe a few more seconds here. We've got a couple of people who just waiting to see, we'll give you 10 more seconds to answer and then we'll show our results. All right, so I'm gonna end that there. And there's the results.
That's kind of what I expected to see. It's hard to convince clients that this is important, but it is really, really important. It's just, this is one of those things that usually ends up being an afterthought. There are the best organizations that we work with, the best ones, all do budgeting and financial planning.
I'm actually kind of impressed that there are that many out there who are doing this management type accounting. That's pretty good.
Okay, let me get that off so that you guys can go ahead and continue.
So just a quick overview of these webinars. They are to introduce tools that will enable you to provide additional services to your clients. That's right, help you upsell. Your client will not approach you about this, almost certainly not. You'll probably have to inquire about their future plans and sell the service. This is really what can lead you to becoming the quote-unquote trusted advisor. It provides higher value services, helps build better relationships, helps your clients feel more comfortable about reaching out to you, and it helps them build and develop profitable businesses. So Bob, this slide, I believe this is your baby. I'm going to let you talk about this one.
Okay. Actually, today's topic fits right in here. So this slide is kind of an overview, of course, of the financial management process in an enterprise. And it's kind of divided. There's the left side and the right side. And the left-hand side, Jonathan talked about financial accounting versus managerial accounting. And you can see the left side is the historical perspective. And down at the bottom, you see there's a measure of the value added to managerial decisions. And the historical information, while it's important, can be of lower value. What happens when you're working in a large organization, management will have questions from their own point of view. They might have gone to a conference and heard something about measuring in a different way, or they might be thinking about their business and they need to really develop some type of analysis of how their product is costed, how expenses flow. So in managerial accounting on the right-hand side, you get questions that are just out of left field, and you kind of have to dig around and pull out information, data sometimes, which is very difficult to dig out, and pull together something that will answer this far out question from management. In terms of budgeting and financial planning, as you can see in the bullets on the right-hand side, those become more predictive. Certainly long-range financial planning, it can go from 3 to 5 years into the future, and it provides a higher value. We'll talk a little more about the value that you get out of doing financial planning, but it's predictive, and it gives you higher value. I just want to say, in terms of this webinar, it's done probably more from the perspective of a large company. And a lot of you may be sitting there and thinking, I deal with smaller companies, although it is possible some of you have larger clients. I think there's value in planning, certainly the budgeting process and financial planning. There's value even in smaller organizations, as Jonathan has already mentioned. And we'll go through some of the ways that this process and going through it can add value. And there are certainly lots of statistics out there which indicate that companies which do planning have a much higher success rate. One of the ways you can tell if a company if a company is going to succeed or fail is, do they do anything to kind of predict and set goals for themselves and targets and try to improve the business in some way? So this is just a kind of a bit of a sales pitch for watching for opportunities to provide your clients with this service. It does add value, and if you know, just to talk about Kata accounting, if you need assistance, or you have a client who's going through some kind of expansion plans, something out of the norm, they're thinking of taking over another business, they're looking for new debt, like anything that's kind of unusual and not part of their day-to-day operations, putting together a budget and a financial plan is likely something that's going to pay back for them.
Yeah. To give a quick idea of how it will pay back, I've said this many times before, and I apologize for repeating myself, but there's a real opportunity coming in the next, we're in it now, and it's going to continue for the next 10 years or so. And that is the transition of businesses from the boomer generation to the next generation. The estimated value for Canada is over $800 billion, and it's going to, of that, 70 to 80% are not going to get the potential value for their companies. Having good budgeting, having good forecasting, and showing that you've been able to really know your business and predict how you're going to do through budgeting and forecasting can help improve the multiplier that you can get offered on the business and drastically increase the price that the owner can receive for their business. To give you an idea, the multipliers usually range from 1 or sometimes even a half to about 7 or 8. So when you're taking a price tag and you're multiplying that by a half, really painful. But if you're taking that and you're multiplying by 4, that's fantastic. Your clients will be very happy with you if you can help them do that. So just some of the topics we've gone over. As you can see, there's a ton of different topics. You can see what we've tackled and what we're going to tackle. So the next, the one we're doing today is financial forecasting, long-term planning. We just did budgeting to lead into it in the last month. And then, yeah, we've got several other topics. Of course, we don't have enough webinars to cover all of these topics, but if there's any of these that, you know, you feel like you need to ask about or whatnot, by all means, get in touch with us and we'll be happy to discuss. So Bob, I know how much you love this, so I'm gonna just let you run a bit
Well, I do love it. I've spent a lot of time in my career.
Yeah.
I got a lot of scars from working on financial planning, but I really enjoy it because it's one area that takes you into into the center of the business. You develop a long-range plan, and then if the company, just one example, if the company is thinking of doing a takeover, and I've had that experience myself, I'll talk a little more about that later on. But if the company is thinking of doing a takeover, the first thing they're going to do is go to the financial planning department and ask you to run a projection of consolidating that business into current results. So you're sitting there with your base plan, which is kind of your starting point, which you've developed over a long period of time. So that's what you think the business is going to do into the next 5 years. I'm accustomed to doing a 5-year plan usually. And then management brings you some financial statements for another target company and says, can you run me a new financial plan where we acquire this company, and how good are the results going to be if we take it over? So to me, it's a very interesting topic. So I have a little picture there. That depends a good deal on where you want to get to. So financial plans, long-range financial plans, help you determine where you want to get to. And as the second point says, it's often used to view results for different scenarios. When I worked at Shell Canada, I remember the Pierre Trudeau government was rumored to be bringing in some huge changes to the oil and gas industry. So we went crazy running sensitivities. So what could they do? What changes could the government make? And we did so many. We used to name our sensitivities using letters of the alphabet. So we did so many, from different managers and executives coming to us and asking us to change the pricing forecast, to change the taxation regime. We ran out of letters of the alphabet, and we had to start going with double letters like AA, AB, AC. So we certainly went through a lot of different scenarios. Now, the strategic planning, we're going to kind of mix strategic planning with financial planning in this webinar because they're closely related. The corporation is going to develop certain strategies or ways that it's going to approach the future. And your financial planning, your long-range financial planning really leads into that. There'll be foundational assumptions in terms of pulling together your long-range financial plan. So we may kind of flip back and forth between strategic planning and financial planning. We're not going to do a separate webinar on strategic planning. Okay, so I just wanted to, found it interesting when I was doing research to pull the webinar together. McKinsey did a survey. I think it's down, the source is down at the bottom of the screen, but I can't really see it.
I don't see it.
What's that?
I don't see it at all here.
I'm sure I put it in the slide. It must have gotten, but
Maybe
this
it's in
is
the notes.
this is a survey by McKinsey of 800 corporate executives of decent sized companies. So 79% of them said that their planning process contributes to development of the company's strategy. Only 45% were satisfied with the strategic planning process. So even though they were using the planning process to develop strategy, they still didn't think that was enough. There were other factors and other techniques they thought should be brought in. Only 23% said that major decisions were made considering the impact of the strategic plan. I found that horrifying, because as you can probably guess, a huge amount of resources goes into pulling together a financial plan and a strategic plan. And then to see that only 23% said that they use their strategic plan in making major decisions, that was pretty eye-opening for me. And the next two kind of talk about whether you have a plan process or don't have a plan process. So 51% of those without a plan process were dissatisfied with the strategy development of their organization. So more than half, but only 21% of those with a planning process were dissatisfied with their strategy development. So in terms of setting strategies, having a planning process, and it stands to reason, it really helps develop your strategy if you have a planning process.
Oh, there's the, the source.
Okay. So this is just a typical process flow. I'm not going to go through this, but you can, as I said, a huge amount of resources go into a financial planning process. Shell Canada had 7 different business units, and each of them had their own planning department, and each of those planning departments would have to go out to operational areas to pull together their projections. Each of them would have to have numerous meetings to arrive at a 5-year financial projections for their business. And then I worked with the corporate group, and we consolidated and pulled together all these individual operational areas. So you can see here from the center, which I think is the executive area in the center of the slide, down to the business units. There's a lot of communication back and forth, and going across this slide, you kind of develop your strategy. And then once your strategy is in place, you go to strategy execution. So that's where you'll develop your budgets, your 1-year budgets, and kind of embed your strategy and your financial projections into plans, specific plans for what you're going to do in the following year. So I put this up just to kind of show you that a huge amount of resources and communication goes into business planning. And now we're going to kind of look at this in a bit of an academic way. What's in a good business plan? Why develop a business plan? Who should participate? And what else might be important other than the what and the why and the who? So we're going to look at each of these questions in order. And Dominique, I see you're responding. Professional or trade, serving oil and gas. Oh, I love oil and gas. Yeah, yeah. We can take a look at responding to this. Jonathan, let's go ahead and look at what's in a business plan. And I like this little quote, so I thought I'd include it. So in a business plan, you're going to get multi-year financial projections. Those will usually be 3 to 5 years. I'm not going to go into a lot of detail on each of these, but this is just to give you a picture of when you put together your planning document, this is what you would expect to see. So those financial projections would include balance sheet, income statement, and cash flow statements. And it's going to, what it should do is define what success looks like. What are your growth rates? What are your profitability targets? What investments are you going to make to get to that level? And so it's going to answer the question, did we get there? There's going to be, there can be a huge amount of supporting detail. One of the most important is what staff levels do you need to invest in to achieve the results that you're projecting. So you can't just stay at the same staff level and say we're going to double our revenues in the next 5 years. It just doesn't make sense. So there are a lot of linkages that have to be thought of and built into a business plan. What investments do you have to make? What's your marketing and sales plans? Operational plans. If you're in a manufacturing business, you have to think about sourcing raw materials, hiring staff if that is required, and what technology upgrades do you need to do. A lot of companies like to upgrade their systems regularly so they don't get out of date, and that takes money. So you have to embed that in your financial projections. And then in a business plan, you want to talk about what are your overall strategies and how does your financial plan tie to your strategies. So you want to make sure there's a linkage there. In terms of a specific outline, this is just one you can pick and choose, and there are different things you can put in, but you'll usually have an introduction, an executive summary. You might have a description of the organization and its structure. You might put in some history, how we arrived at the point we're at. You could put in vision, values, and your corporate mission statement. You'll usually include major assumptions because they will impact throughout as you're looking at the financial plan. Strength, weaknesses, opportunities, and threats analysis, which is a pretty common business model. And you always want to think of the environment. And by the environment, I mean, what does the economy in the geography you're operating in look like? What are your projections for that? What does the political situation impact? Anything out in the environment that's not directly controllable within your organization, but is definitely going to impact you, will have to be thought about in terms of inputs. You're going to, of course, include financial projections, key performance indicators, and there may be some qualitative goals that really aren't measured in terms of traditional financial statements. Like one example is a customer satisfaction rating. You might only be at 70% customer satisfaction, and over the 5 years of the plan, you want that ramped up to like 95%. So that's a more qualitative goal. And then you want to talk about how you're going, and this is, I haven't seen this done very often. You want to have an evaluation of your business plan. How are we going to follow up? How are we going to assess what we said 3 years ago we were going to be doing today? So you might want to talk about what process you're going to set in place to determine if you've achieved success or not. So the next question is why plan? There's a little picture which indicates why you might want to plan. So pretty quickly, you plan because you want to identify threats and opportunities. You want to think about the future and set yourself some goals, or think about where you want to be. And I know from experience that it's much better to be developing a plan when you're not under pressure and stress, when you have to kind of develop responses to situations in a very stressful environment because something has happened. Company I worked with was looking to make a major acquisition. They were throwing off a lot of cash flow, and that made them a target for takeover themselves. Businesses would buy out their shares on the public stock markets and then use your own cash flow to pay for the acquisition. So I came into work one morning and expecting to work on some acquisition targets, and it turns out it was all over the news that an offer had been made on the shares of my company. And from that moment, for probably the next 3 or 4 months, we were in a very stressful environment, I can tell you from experience. So you plan because it's going to promote communication between operational and management areas. And the next point, it reveals disagreement among management team members. If your factory management is planning for an expansion and your senior executive is thinking of reducing production because it's inefficient, you're pulling in different directions. So you have to have everyone get together, all these different departments, and make sure there's a common thread and kind of common position being taken among the management team. And lastly, it leads to knowing how, step by step, you're going to progress towards your goals. So that's why, very quickly, who should participate? Generally, the senior management team is upfront about this. You should have good communications. There should be a lot of discussion back and forth. This is one of the most important tasks that senior management will do, and they need to talk it out, basically. But it's often useful to include managers one step below senior management because they're closer to day-to-day processes, and there might be an issue that the manager of the department is aware of that really needs to be addressed, but it hasn't been brought to the attention of the vice president who's on the senior management team. So in some way, it's good to include another level of manager in the process. So other considerations when you think about pulling this all together. Someone should be directing it with a high level of influence, credibility, and experience. Someone that people, they can walk down the hall and walk into a vice president's office and they get attention. It shouldn't be someone who's just going through the actions and it won't have much impact. And because quite often inside a company, there may not be a person with broad influence, they often bring in outside consultants and pay huge prices to expedite the process. But that gets everyone's attention, and it's usually supported by the top level executive, the CEO. The focus is on effectively using your limited resources. So you'll be looking at capital investments and staff growth. You may consider changes in capital structure. You're going to be looking at this, and that leads to maybe you're going to issue some shares or put out some new debt instruments. And I've talked about environmental considerations. You'll want to embed those in terms of your plan. And you're going to use the model to run sensitivities. I've talked about that. And you want this model to be used, not just kind of, we did it, we put in all these resources, and now we put it on the shelf, and next year we'll do it all over again. No, that's not the idea. So I wanted to go over, I think we're getting towards the end. I wanted to go over some examples of bad planning. I didn't know this, but Kodak actually invented the digital camera. Someone working in their head office in a back room somewhere, according to the story I read, invented the digital camera. And what they said in the article, this camera had 0.1 megapixels, and it was as large as a toaster. So it might not have been a very popular consumer product, but they were in on the ground floor, and the person who invented it really wanted to push it and get it to the marketing stage, but management suppressed it because their main business was film sales, and they thought they would cannibalize their film sales, so they put it on the shelf. They didn't pursue improving the digital camera. So, and now where is Kodak? Gone. BlackBerry, who was once the king of the cell phone area, their big push was to sell to corporations, and then the corporation would have all their staff using the cell phones. They didn't realize that their end market should be the individuals who wanted to play games and who wanted a screen they could move around rather than these buttons. So BlackBerry kept trying to market to corporations, and we all know where that went. You'll remember back when McDonald's thought they should introduce salads. Everyone was on a health kick, and but McDonald's core competency obviously was not health foods and salads. So in terms of a strategy, you need to know your core competency and stick to it. And the last example I found out about is Kmart and Sears. Where are they today? And I read their mission statement, and their mission statement was, it was very wordy, and it was highfalutin, and we are a major corporation, and we deliver quality products to everybody out there, and we're everything to everybody, blah, blah, blah. Versus Walmart's focus, low prices, very focused. They know what they're doing, and everybody who works at Walmart knows that that is the target. And speaking of Target's focus is kind of fashion and chic fashions, and everybody that works at Target knows that that's what their goal is. But Kmart and Sears, people had no idea what they were trying to be. So some other examples over the course of the years, that things that were great, but or may not have been great, they were not consistent with the overall corporate strategy, and I've listed them there. Levi Type 1 jeans was an idea back, I think, in the 90s. They even rolled them out, paying for a huge Super Bowl commercial, which are not cheap, and it just didn't suit consumer tastes. They hadn't they hadn't figured it out yet. So the Ford Edsel car and some of the other ones I've listed there. So there are some examples of bad planning.
I love this quote.
And everyone can use a little self-deprecation. So I wanted to end it with my own personal example of bad planning. So I'd mentioned that I was manager of financial planning for a large multi-billion-dollar public company, and I had been able to develop a 5-year forecasting model, presentations to the board of directors and stuff. And the company, as I mentioned, gave you a hint about, we were throwing off excess cash. We were in a utility business, well-known utility, and we had some very popular consumer products that were throwing off a lot of cash. So we were looking for a major acquisition. Companies like Campbell's Soup, I remember, was on the list, and Rogers Broadcasting. And I don't know if it was a takeover of Rogers. I think it was more like a partnership where we could invest some of the excess cash we were bringing off, and it was specifically into the cell phone markets. So I'm dating myself. This was the very, very early days of cell phones. And Rogers had presented us with projections of cell phone sales, which were, I've never seen future projections that were as aggressive as this. Like, I can remember sitting in a room and we were talking about it, and someone brought up, if we realize this kind of growth rate, do you realize that in 8 to 10 years, every adult in Canada is going to own a cell phone? Like, that ain't ever gonna happen. So of course, the projections they presented to us turned out to be much too low. Just a little addendum, we did not get to the point of making an acquisition, and that was the Monday morning story I told you. I came in on the Monday morning, and someone else had bid on us on the TSX. They had put in a tender offer to buy a pile of our shares. So we were now the company that was in play. So we should have jumped on the cell phone fad. So I'm not totally useless. I can be used as a bad example.
I like how you call cell phones a fad. That was nice.
Yeah, well, yeah, it was true at that time, we thought.
Fair enough. They're probably the size of cinder blocks.
Yeah.
So we're into our last poll question. Okay, Leanne?
Yeah, we're all set.
Okay, so what's the best way for a company to ensure its strategy is effectively implemented and followed?
And this is just an opinion.
Yep.
You can read the 4. I've always been interested in this. So how do you think you can keep people and keep the overall organization best focused on the strategy and making sure it's followed?
All right, so the poll is up. We're just waiting for everyone to have a chance to read through those answers and give their thoughts. So if you guys...
I have my own personal favorite, but like to see what everyone else thinks.
Yes, and then we can have you weigh in. So we're just waiting on a couple more. I'm going to give it about 10 more seconds, and then I'll close this off and we can view those results.
I wonder, Bob, if my favorite is the same as yours.
All right, I'm going to end that, and there is the results for you.
Hold quarterly management meetings. Oh, so nobody likes reviewing prior year plans. Time management comp. and develop key indicators and report regularly. Okay, yeah, that's good. My personal favorite, and I don't see this done effectively, certainly in a lot of the companies I've worked in, is the tie management comp to strategic goals. There's no better way I've learned to, I've seen how managers and executives focus on their compensation. They will never tell you, nobody will ever know, but having been in the situation where I actually calculated some of the measures of management comp, boy, if you do something in your calculation, you'll get the executive breathing down your neck because you've done the calculation wrong or because it isn't good enough, and they want to make sure that it is done properly. There is a huge focus on bonus measures, basically. So I kind of like that one, but I think these other, they kind of all have their place.
We've heard so many stories in the media about senior managers completely tanking companies and then getting massive payouts on exit. And those kind of things, I think, really, I mean, there's no accountability when that happens. I would agree 110%. I would extend it further down the line too. And, you know, apply that to production worker bonuses, to, you know, various levels of management and of employee, you know, to achieve targets that are within their control in order to adhere to company overall strategy and move the company forward in the right direction. I would agree wholeheartedly. So, okay, so we're into questions, but I would like to start. Dominique has written a small essay to us.
Yeah, I love this. Obviously, someone after my own heart who's really invested in financial planning and supporting it, and how it, and I think Dominique likes management comp as well, according to her comment there. Yeah, it's still important to look at shorter term measures and have your KPIs for kind of day-to-day activities and your monthly reporting. But that's not as interesting as financial planning and all of this good stuff.
So just a couple of quick resources, just from a quick skim of what Dominique wrote. Industry Canada has a lot of benchmarks. They have a lot of information there. Industry periodicals can also be a great source when you're doing a SWOT analysis. And as bookkeepers, I'm sure that one of the big opportunities and threats right now is technologies such as AI and machine learning and the cloud. I mean, they present opportunities, but they present threats at the same time if you don't seize those opportunities. But yeah, there's a lot of ways to get some information. Unfortunately, with smaller private corporations, it's very difficult to get direct comparisons. I have yet to find a good source for private company information, and that's usually because, hey, they're private companies for a reason. So.
Mm-hmm. Wow, I'm reading the essay that Dominic. Man, I worked at Shell, so I know what you're talking about in terms of changing environment and challenges to doing planning and the tools you need to do it. Like you mentioned, spreadsheets, and if you want to have a chat sometime about this, we can certainly.
I feel like we need to grab some coffees and book a couple hours with Dominique just to sit around and chat.
Yeah. And obviously very invested in the oil and gas.
And that can be tough because in certain industries, you're a taker, right? You're not a setter. You're not a leader. So, you know, if you know OPEC decides to increase production and it lowers the price of oil in the global market, everybody reacts to that. And unfortunately, the smaller players like the pipe fitters and the guys who are out in the field, they don't have any way of predicting or combating that. I mean, maybe you can make predictions based on the market, but that kind of major change can really hurt, right? So you'd love that in July. Okay, I'm going to put a note in my calendar to reach out to Dominique in July. Are there any questions, comments, things like that? Anybody have any other opinions about how things should be done?
Subcontract. I'm just reading through some of Dominique's.
If anybody else has any sort of comments or questions, please feel free to type it into the chat, and the guys can take a look and hopefully comment back on it. I do want to say, from a bookkeeping firm perspective, you guys mentioned about how this is an added value, and your clients are not going to, they're not going to come to you seeking this sort of upsell. You're going to have to provide it. And that's definitely something that we have done within our firm. And essentially, the key for us has been, we have to go out and we have to prove the value and that we can offer those sorts of services, either by demonstrating it to the client. And then once we've demonstrated something and given them maybe a little bit of a bonus on top of what they're already getting, we're using those situations to then say to them, well, if you want this on a regular basis, you know, this is what we can do for you and this is what it will cost. So sometimes it helps to give them a little bit of a demo as to, hey, by the way, I can do this.
So
absolutely. That also works in the consulting area. I've found almost every consulting contract that I've worked on, the client asks me, what do you charge? And I tell them, and they say, ooh, that's more than we wanted to pay. And our range was, and then they quote something 20% lower. And I stick to my guns. And then when you get in there and start doing the work and showing them the results of your work, they can't get enough. You end up working overtime because they love what you're doing and they want more. So that really applies.
I was going to say something about that. I can't remember what it was now. Anyway, any more questions?
Yeah, Dominique says, how can a services-based corp with 1 to 5 employees track market conditions in planning? One of the ways is to use a service, or if you have several clients who need the same type of predictive economic information, maybe you can subscribe to a service. There are all kinds of them out there that'll project and write very learned, scholarly articles on where they think things are going. And you can kind of charge it out a little bit to each client so that, you know, none of them have to pay too much, and you're still providing the service.
One of the things that we do is when we do the taxes, we usually, after everything is done, we provide 2 or 3 KPIs, or items that in our opinion are KPIs. So one of our favorite clients is an importer of food, or distributor of specialized foods. And so we might look at them for their gross margin as compared to industry averages and see how they're doing on that line. And then look at things like, you know, accounts days receivable and inventory turnover ratios. And that can kind of get a hook into the opportunity to upsell those additional services.
That's a great thing to do, like right after you've provided them with that, to kind of give them that added value. That's fantastic.
Exactly. All right, well, go on, Leanne.
Yeah, I was going to say, I don't think there's any other questions. So if there's nothing further, then we can end the webinar here.
Thank you very much for attending, everybody.
Thanks, everyone.
And thank you to you both again for another great webinar. I mean, the information is fantastic, so we really appreciate it.
All right, take care, everybody.